Yeah. So some of the key, what is your understanding of the budget? So he is just talking about government budget. Is just define the government budget. All right. Which you just talk about is the estimated spendings and revenues for the government. Then everything is so clear, I think, in your madam's lecture notes. What are some of the macroeconomic indicators that are discussed there? So one of the macroeconomic indicators is um, the government expenditure. I think the budget deficit and surplus. So you look at those things, you look at the government expenditure and the government revenue, which is the taxes. All right. So which will talk up to take us up to some of the policies that the government can do. I think that one will be answered in question E. So I think all these are pretty much theoretical, right? Define direct taxes and indirect taxes, discuss sources of non-tax revenues. So you have these things such as royalties. I think there's a big list in your lecture notes that was given over these in under the public sector. So all these answers are found there. You have things such as royalties, penalties that the government can earn. You have road tax, not this non-tax, right? So we have, for example, what do you call this? Money from the toll gates. Yeah, the government can charge royalties, licenses. All those are some of the sources of non-tax revenues. But I think it's a huge list that is there. Then what is public debt? All right. All these are things that I think they're all together. So I thought maybe for this one, it would be best for us to look at things that will require some calculations, right?
What of E?
Which one?
E. Does it require for us to come up with a diagram?
Yes, definitely. So this one says in the IS ADS model, what policy can the government take to expand output, right? Given a long run aggregate supply function, how would this policy impact the prices? So here you just draw the three. And talk about the short run and the long run. So you know that together, everything will be like this. Remember, we're not doing the long run. Okay, I'm trying to draw this straight, pretend it's a straight line, okay? Yeah, then we have price here. Then we have output. So you know that in the long run supply curve is a vertical line, long run aggregate supply. In the short run, this is our aggregate demand, straight line as well. And aggregate supply is right here. So this is aggregate supply, the short run. So sometimes they'll put like this SAS or SR, they'll put the SRAS like this. So what will be if the government wants to increase output, what can the government do? So government can raise G, isn't it? So if they want to increase output, meaning they want output for us to produce beyond this. So the government can carry out what we call the expansionary fiscal policy. Since they want to expand output. So the government can carry out expansionary fiscal policy. And what is this? They can increase G and lower taxes. So when this happens, the AD will shift to the right, like this. So this is our AD1, this will be our AD2. So you can see here that output was at point Y. Now it has increased and gone to point what? Point Y2. We can call this Y2. So you can see that there's an increase in output, isn't it? So you're right to say in the short run, the government can carry out expansionary fiscal policy to increase output, right? So output will increase, but what is happening to prices? You can see that prices are also increasing, isn't it? So you can see that as we are at this point, both of them, prices and output, have increased, right? So you'd have answered that first part. In the short run, both output and prices will increase. Now it says to say, given a long run aggregate supply function, how would this policy impact prices in your economy? So given if you're now considering the long run, output won't increase because in the long run, you know that your supply curve is vertical. It doesn't. So what I've described at first is in the short run, right? Output is going to increase. But in the long run, given a vertical supply function, you know that this is what you have. This is the AD. If the government carries out expansionary fiscal policy, what will happen is the AD will come here. You've seen that output is not changing. We're still remaining at the point Y star. But what is changing here is the prices. So prices were at this point, P1. Now we're going to find ourselves at this point, P2. So as you are carrying out this expansionary fiscal policy, what is going to happen is that prices will continually be doing what? Increasing. That is all. Okay. So the policy will increase prices in the long run. And you would have drawn that. That's all. Okay. Oh, good. Yeah. And this was the question 5. Then the other one, I think I'll just I'll summarize everything to you. I want to talk about something else since we've looked at national income, but let me just run through it quickly. So the first question, you have been given all this, consumption been given as that, tax is 0.1T, which is the tax rate, investment is 25, government expenditure G is 800, exports are 200. And then the imports are also given as that, and it says calculate equilibrium income. I'll calculate the equilibrium income and the multiplier in your economy. So remember, if you're calculating equilibrium income, first break down the consumption function. After you break down the consumption function, you now also bring in the imports minus exports. You also simplify it. So you say 200 minus 100 minus 0.2. And after doing that, then now you can bring down everything together where you say y is equal to, you know that at equilibrium, y will be equal to AD. Y should be equal to AD, right? Then you just bring in your y is equal to the C plus I plus G plus NX. So you first work with the consumption function alone. So you write consumption function, simplify it. Okay, by simplifying, you know, to say we said you have your A plus your CY, isn't it? So you replace where there is that, you put the taxes. So for example, the consumption function at first will be equal to, if you take a look at this question, our consumption function has been given as, we have 200 plus 0.6 YD. So it's 200 plus 0.6 YD. So consumption function is 200 plus 0.6 YD means Y minus T, which is our tax rate, which will be equal to 200 plus 0.6 Y minus, what is the T? The T is the 0. Is it 0.2? I think this should have been 0.2, right? 0.1. So 0.1 Y.
Why?
So 0.1 Y like this. Then you just simplify this. Now, this is 200 plus, you can say 0.6. Y minus 0.1 just gives us 0.9 Y. Yeah. Then from there, you just calculate and find this will be 200 plus, what's 0.6 times 0.9? You have the answer, I think. Okay, from the calculator here, you get 0.6.
0.54.
Yeah, so 0.54. So you get your 0.54. So this is going to be your C. Then you also do the same thing for the NX, net exports, which is exports minus imports. So your exports, I think we have been given a number. We have our exports are 200. So
200
200 minus the imports is 100 plus 0.2y.
plus 0.2y.
Yeah. So it will be 200 minus 100 plus 0.2y. So from here, you just say 200 minus 100 minus 0.2y, of which I always emphasize the negative multiply it. So here we're just going to have 100 minus 0.2y. After getting this, now you can bring down everything and just say at equilibrium, y is equal to C plus I plus G plus NX. So what is our G? Our C is 200 plus 0.4y, 0.54 0.54y, plus you get your I, you get your G, then you say plus this here, the nx that we found. Then that's all. You now just find the value of y using algebra. Okay. I hope we're all good on this. I believe so, right? That's how we calculate equilibrium income. You won't find any difficulties there. A multiplier, looking at what we've been given here, it's a full multiplier, isn't it? So concerning the multiplier here, we'll have the multiplier will be equal to 1 over 1 minus the MPC, then 1 minus T plus M. So you put down your values. This is 1 divided by 1 minus our MPC was 0.6 from the question. Then 1 minus the tax rate has been given as 0.1. Then plus this M is the marginal propensity to import, which we have. You look at your imports, then this part that is attached to Y, the 0.2. This is the one that you put there. So of our 0.2. Then from here, you just follow BODMAS. This is 1 over, you first work out this. Don't multiply first, just say 1 minus this. So you say 1 minus the 0.6, then that will be 0.9 plus 0.2. So you can just punch this now on the calculator. First, you break down this as well. This will be 1 over 1 minus 0.6, that's 0.9, is 0.54, then plus 0.2. Then again, you simplify this by adding, then divide that. You can just now get a calculator and put that. Then you find the value of the multiplier, which we should be able to give us, I think, let me just do this. I'll say 1 minus 0.54 plus 0.2. It's giving us 0.6. 0.66, which will be equal to, the answer will be 1 divided by 0.66. Our multiplier is 1.5. That's all.
So this one, Mr. Duncan, is just the same like the formula that you have written there. Just the same like the one that we write, 1 over 1 minus b plus b, isn't it?
It's the same thing, yes.
Like
Yes, this is the formula for the multiplier. Everything is the same thing.
Okay.
That's all on how you calculate the multiplier. But I have a specific class on this as well in details over the multiplier. Of which case do we need to apply this one at which point? All right, but to answer that question, that is all. Then I'll get to this other one. I think it says, calculate the change in equilibrium income following an increase in exports by 100. So exports have increased by 100. How will our equilibrium income change? So you know that the multiplier shows us a change in equilibrium income when there is a change in aggregate demand, any component, autonomous change, right? So in autonomous, and there's a change in autonomous expenditure. But this time we're going to say change in Y. Which autonomous expenditure is changing? Is the change in exports. Exports are the ones changing, right? So they've told us if exports increase by 100, by how much, what will be the change in equilibrium income? So we're going to say our M, what is our M? We found our multiplier to be 1.5. We calculated as 1.5. So we'll say 1.5 is equal to change in Y is what we're looking for. Exports have changed, have increased by 100. So you put the 100 there. So you cross multiply change in Y will be equal to what? It will be 15, right? Because 1.5 will just have a 0 there, 150. Is it? Should be able to give us a 150, right? Yeah. So we have 1.5 times 100, which is 150. So this, and this is our final answer there. All right. I hope it's all good. This as well, another theoretical question. What are the advantages of free trade? Meaning free trade, we don't have anything that is being charged, right? So here there are no barriers whatsoever. What are some of the advantages? All right. So here we have the free trade gets to encourage investment. So one of the advantages of free trade is that it encourages investment. Right. It also encourages high productivity. Okay. And also brings about the aspect of efficiency in terms of production, efficiency in production or specialization, that is. Because if there's free trade, everyone can buy things from another country without sanctions, without tariffs. So with that, it means a country like Zambia can just specialize and say, since we'll be able to buy food from other countries, let's not panic we start producing other things that were not good. Let's just specialize. So it brings about specialization, which improves productivity. So when there's free trade, investment is high as well. Okay. So I think those are some of the advantages that are there. All right. So what is the other thing? The other advantage is that because you know that investment is going to increase, you can also, one of the advantages that it brings about high employment. Employment rises because if there is investment, you know there'll be employment, right? And the other one that is there is that it also brings about high, it brings about economic growth. I saw a question on GDP. Okay, I think I skipped this, right? All right, let me just do this one quickly because it's very theoretical as well. So it says a loanable funds theory comprises, question 2, the loanable funds theory comprises the supply of loanable funds, credit in capital markets by households, businesses, and governments. These same entities demand loanable funds, demanding more when the level of interest rate is low and less. So it says interest rates are higher. Commercial banks, okay, what did I read? Yeah, okay, let me begin from here. Commercial banks are financial intermediaries because they connect borrowers or loanable funds to lenders who grow money in the process. So now it says required, which is the question, assume that there is only one bank in the economy, an initial deposit of 300, a reserve requirement of 10%, fixed assets financed by share capital worth K20, show the bank's balance sheet of the commercial bank on the first days and on the final day, which is just the same thing. So when you're dealing with when we're dealing here with the aspect of the balance sheet, you know that the balance sheet, you have liabilities and you're also going to have assets on the other side, and they should be equal. All right. So if you have liabilities of 300, then the assets should also be 300. That is, should be the bank's balance sheet throughout. It will not change, okay, unless there is a change in either the liabilities or there's a change in the assets, but otherwise it always remains the same. So if we have the liabilities, whichever you want to put on the right or the left, it doesn't matter. So liabilities or liability, then you also have the asset here. All right, so whatever will happen. So on the liability side, we have the 300, which is the initial deposit, isn't it? I think this is the only liability, right? Now on the asset side, we'll put the reserves. So required reserves. So required reserves have been told it's 10%, right? Required reserve is 10%. So it means we'll put the 10% there. So 10% of 300 is what? 30 kwacha, isn't it? 30 kwacha. 30 kwacha is 10%. 30 kwacha is 10%. 10% of 300 is what? 30 kwacha, isn't it? 30 kwacha is 10%. 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 30
Yes, it is.
The bank, does it have any assets? Yes, it does. We have the fixed asset. I think, what's the name of this? Yeah, so fixed asset financed by share capital worth. There are how much? It's 20 kwacha, isn't it? So we put the fixed asset. Yeah, fixed asset is 20. Then now, whatever remains has to be equal to this 30. Okay, so whatever remains, this we're going to loan it out. So how much money is going to be there? So we have 30 plus 20. How much is there? That's 320, right? 350. Isn't it? Yeah, this is the 50 rather, isn't it? So in order for it to be equal to the liability, then it means the bank is loaning out 250. So 250 is the amount of money that is remaining. Then this is going to be our balance sheet like this. Okay, so always note that these two should be equal. So you can see this is balanced. This is the 250. We have a 20, which is the fixed asset. Then we have the 30, which is the required reserve, which they're keeping. Then the liabilities are 300. And so you add up these, should be able to give you 300. So just ensure that you put down the reserves and you also put down the fixed asset. Whatever money that remains to make up the liabilities should be equal to the loan that they're going to give. All right. So that's how you put down this. And I think this is coming, I've seen it in quite a number of papers. I think you also have, right? And then this one here, which says explain the various motives of liquidity preference. So the various motives here is just talking about the reasons why people hold money. And remember, there are those factors that talk about, we have the precautionary, the transactive motive. So there are three reasons. So there's the transactive motive, which is explained as people will need money for day-to-day transactions, right? And it says what factors determine the amount of money that is held under these motives. So there are mainly two factors, okay? At the first one is the transactive motive, right? So under the transactive motive, people, why would somebody choose to hold money under transactive motives? So you not say it's for their day-to-day, but the amount of money that they're going to hold, what will determine it is the amount of income that they have. So it's their level of income. If I have a lot of income, I'll hold a lot of money for transactive purposes, right? So the first one is income, which is a determinant. So the higher the income, the higher the money that a person will have, right? Remember the consumption function. We have income. When there's high income, consumption rises, right? So income will determine it. The other one that will determine it is, so we have the income, then also the level of interest rate. So the higher, if interest rates are high, people won't hold money for transactive purposes. They would love to hold it. And other reasons, such as the investment reasons, you would love to invest your money, right? And earn more income. So these are the two. So income is the first one, the level of income that a person earns, and also the level of interest rates. All right. Then the other reason why people decide to hold money for liquidity preference. So the second one is the precautionary motive. So precautionary motive, these are just the precautionary motive is people hold money for unforeseen events, isn't it? Or unexpected events, unforeseen events or unexpected events. And the amount of money that a person will hold under this motive will be determined by their psychology. So yes, it's psychology of an individual. So if you are those people that will think, you don't know how tomorrow is gonna, what if we have COVID tomorrow? And the fear in them will make them to save even more money for unforeseen events, right? Okay. So psychology and also the level of interest rates, okay? And also income rather, not interest rates. So the psychology of an individual and also the level of income. If you know you don't have any income, you can't start keeping money for unforeseen events because you know to say every money that you need, if you have low income, obviously you will have to spend it, isn't it? So yeah, the psychology and also the level of income. All right. So the other one is the speculative motive. Speculative motive, people hold money for investment purposes, and that one is usually determined by two things, which is the income. So income determines all the three: income and the level of interest rates. So the higher the income, the higher a person would love to keep money for speculative purposes, and the higher the interest rates as well. If interest rates are high, obviously you'd love to not hold money, isn't it? If interest rates are low, then you decide to keep money. So this is for investment purposes when you look at the speculative motive. Then the other one which you'd love, if you just want to earn more marks, is the price level, right? So price levels, if prices are high in the economy, people would love to hold more money because if, for example, you're buying bread at 10 kwacha, and if they tell you that bread has increased to 20 kwacha, that means to buy the same bread that was worth 20 kwacha, that was worth 10 kwacha, you now need more money, isn't it? So you're going to demand for more money. So if price levels are high, people need more money to buy the same level of, to buy goods and services, right? Okay, so those are some of the reasons for why people hold money. All right. And then we have this question that is here. What are the three conflicting objectives of a commercial bank? Now, the three conflicting objectives. The bank has, the first objective for the bank is to make profit. So the bank wants to make profit. This is their objective, right? Objective number one. Number two, the objective is that they must be liquid, okay? The liquidity, not liquidity, it's just the liquid, okay? The bank must be liquid. In terms of that, we mean whenever a person wants to go to the bank, they must always find their money. So you don't want to be in the place where your customers come to the bank and they don't find money. So you should always be liquid. So meaning customers should always find their money. And that's the reason why the commercial banks are required by the Bank of Zambia or the Federal Reserve to always keep reserves. This is the objective number two. Okay, this is the other objective. Then the objective number three that they have is that they must always have securities. So in terms of securities, the bank should not only rely on loans, but they should also have other investments that they can always rely on, is to ensure that if money, for example, people come to the bank and they want to have all their monies, they don't have only to depend on their reserves. They must also have shares in other companies. They can buy shares, okay, or they can buy bonds, government bonds, so that they can have all these monies that are there. Now, you see, if they want to make profits, they have to loan out as huge amount of money as possible. But as they're doing that, they must not forget about these two things. Okay, they must be liquid and they must also hold securities. So, and to buy securities, you know that you have a conflicting objective, which is the making profits, because it means the more liquid you will be, the less money you can send to make profits, isn't it? So, profit, you need to loan out a lot of money. Liquid, it means you don't have to loan out all the money. You have to keep some money available for any withdrawals. Then securities as well, because you want to keep money as liquid so that people can come and always withdraw. You always also have securities, which when you go and invest, it means you won't have the money here, because these securities are just the other way that the bank can make money apart from loans. Okay, so you can see that these objectives are conflicting one another. If the bank wants to hold more money, wants to make more profit, they have to loan out all the money. But as they're loaning out all the money, there is the aspect of liquidity that they are foregoing. And as they might be wanting to be more liquid, they also have the aspect of securities which they need, so that in case anything runs out, they can always get their shares, they can call out their shares or call off their bond and earn that money. Okay, so these are the three objectives, conflicting objectives of the bank. All right. I hope that is okay. Okay. I had the 15 minutes that I wanted to share with you concerning this. I think the questions on the GDP, the CPI, I think that's the only part that is remaining. I don't know if there's any question or you have all slept because I feel like I'm the only one awake now. Yeah, there's this.
Yeah, for now.
Yes.
No, there is another.
Yes, anyways, in
There,
5 minutes, let me give you this. I think I've seen something under GDP. Okay. Yeah. All right. So we have this, the annual inflation. Okay, you can read this. This has nothing to do with the questions. All right, so we have that statement that is up there. It says, discuss and illustrate the sources of inflation using the Keynesian and monetarist view. So remember the inflation that we looked at the Keynesian view, of which the Keynesian view, they talk about the demand pull inflation and the, I think demand pull inflation and the cost push inflation, right? So looking at those, you can know to say anything that will raise the AD, for example, a low interest rates, right, will cause the AD to go up, right? So it means it's a cause of inflation. So anything that will cause the AD to go up, it will be known as the source of inflation, right? So since there are 6, you can just name 6 under the Keynesian and yes, maybe 4 under the Keynesian and just 2 under the monetarist. So under the monetarist, they only have one reason why inflation is there, and that is an increase in money supply. So for them, they'll just say increase in money supply will lead to an increase, according to the monetarist, an increase in money supply will lead to an increase in inflation. Whereas the Keynesians, they have all these other reasons. They say it's not money supply, which is the cause. We have the demand pull inflation, which is caused by anything. For example, an increase in we spoke about, I think, interest rates. Then the other thing I think I spoke about was the confidence, consumer confidence and investment confidence. So if investors are confident, investment will rise. If consumers are more confident about the economy, they'll spend more money because they know things will be well tomorrow, right? So you have all those things I think that we discussed in class under the Keynesian. So under the Keynesian, you have the cost push and the demand pull inflation, right? Those are going to be the sources of inflation. All right.
so for A, it's about inflation. That's why we find this, isn't it?
Yes, it says discuss and illustrate the sources of inflation using the Keynesian. You know, under the Keynesian, it's the demand pull inflation and cost push inflation. So what causes those two? That's what we discuss. Monetarist is only money supply. They just say an increase in money supply will cause inflation. So most of your points then will come from the Keynesian. And that's all. You remember the class that we had on this, right? On inflation. I think I sent to you. Then the other part now that we have, I think, okay, let me talk about it in 2 minutes. It says, assume that the final GDP, final 2020 GDP at current prices has been estimated as this compared to 300,000 of 2019. Calculate the nominal GDP growth rate. Now, when it comes to GDP growth rate, it's just the current GDP minus, so current GDP minus initial GDP divided by the initial GDP times 100. Okay, so it's current minus initial divided by initial times 100. So for example, here we have our GDP of 2020 being this number here. So you get this number, which is the 2020. The initial was 2019. So you get this number. So it's this number, which is the current for 2020, divided by this number, minus this number, sorry, then divided by the initial as well, which is for 2019, then times 100. That's how you find it. Okay. So you just get the current here is 2020, right? So the GDP in 2020 has been estimated as this one. So this is the current. So minus the initial, which is for 2019. This is the GDP for 2019. Then divided by the GDP for 2019. Then times 100. That's how you calculate the nominal GDP growth rate. Then the next one says, in addition to the information provided in B, the final GDP, now it says at constant prices, this thing is real GDP, compared to 141 in 2019. What it says, calculate the deflator. I'll talk about this in the next, I think we're just remaining with 15 minutes. I'll show you how to calculate the deflator. So it says calculate the deflator and consequently the inflation rate. So I think in the next class, let me just talk about how you calculate this deflator and the CPI. I think then we can be done. All right. So let me cancel it and send it.